Where can you get a 9% raise every year?
Our average company has grown its dividend at about 9% rate a year since we launched the product over 20 years ago, and we broadly think that can continue.
Hello, I'm Consuelo Mack on Wealth Track, providing cash and protection in turbulent markets. Michael Clarfeld has been doing it for years as co-portfolio manager of the ClearBridge Dividend Strategy Fund. He's next on Consuelo Mack Wealth Track. Mike Clarfeld, welcome to Wealth Track.
Thanks. It's terrific to be here. Appreciate the opportunity.
What are you telling clients about the markets? And let's split it up. What were you saying before the Iran war? And then tell us now what you're saying.
As always, there's a lot of good things going on and also some challenging things going on. And I think the message that we've been focused on for the last really couple of years is that the developments in technology, particularly around AI, are very exciting, and clients should want to have exposure to them. And at the same time, clients need to be mindful of the amount of concentration in the market today. So over the last few years, as technology companies have done well and as investors have become very enthusiastic about the prospects for AI, technology stocks have come to really predominate the market indices, and the market has become incredibly concentrated, such that broadly defined technology stocks are probably 40% of the S&P 500. And so we think that it's important that clients have exposure there, but also be mindful of the fact that never before in history has a single sector been anywhere near 40% of the overall market, and that it's of paramount importance as an investor to always maintain diversification and be mindful of risk. Now, obviously, with the outbreak of the war in Iran, the risks have sort of increased and also compounded and also probably changed. And so in a market that's concentrated and that's relatively highly valued as the market was kind of coming into the year, you never know what could be the spark that sort of leads to a sell-off in the market. But clearly a major war in the Middle East is the kind of event that could do just that. Additionally, obviously, it's touching oil, which is the most important commodity in the world, which has impacts from an economic perspective in terms of oil being a raw material that goes into so many things, oil being a major expenditure for so many people, and so the impact that has on inflation. And so really, while we've been focused the last few years on both the opportunities but the risks in AI, given the concentration, the war in the Middle East has both introduced a broad risk, but also then specific risks around things like inflation, a recession, et cetera.
Right. You sound so rational in describing the environment. Some people are really upset about what's going on. There's a tremendous amount of uncertainty. And as we record this, we've had a correction, which means a better than 10% decline from recent highs in some of the major market indices. So given the disruption of the war, given the fact that before the war that we're talking about super high concentration in tech, and also that valuations are very high as well, it sounds to me like the market's pretty risky.
There are a lot of ways in which we do believe that there are some big risks out there in the world and in the markets, right? At the same time, though, I think that one of the things that we're finding, particularly of late in the market, is that there are opportunities out there with the volatility in the market, with the myopic focus that investors have had on AI. One does get opportunities to make reasonable, conservatively underwritten investments in other areas. And so it's not all doom and gloom.
Where are you looking?
It's really been idiosyncratic for us. So sometimes it's easy to say we're hoping or thinking that our next great investments are going to happen in this particular sector. That is not the case today. What we focus on, and what we've always focused on, but probably sounds even better in today's world, is really finding high quality companies in businesses that we understand and that we can underwrite with conviction, and businesses that we think have a relatively low risk of disintermediation. And so one of the terms that people are talking about right now in investing is looking for HALO assets, HALO, hard asset, low obsolescence. And I wish I could say I was clever enough to come up with that acronym, but we weren't.
For more information about Clearbridge's dividend strategy, go to wealthtrack.com. And we are continuing our conversation with Mike Clarfeld about finding promising HALO investments.
So we've always emphasized businesses that operate in the tangible world, that make products that we understand, operate in market dynamics that we can understand and that we can have a pretty high degree of conviction are not going to be disintermediated by a new technology or new player. It's a good business and a good industry today will be a good industry 3 years from now, 5 years from now, 10 years from now. So you think about things like their easy examples would be logistics companies, right? Whatever happens in the world, we're still going to need to move products around, and that's not going to change. You think about things like communications companies, right? So while AI is changing so much about technology, the amount of data that people are using, the amount of data that people are transmitting is growing very powerfully, which has positive implications for people who own communication systems, whether that's fiber optics or cable systems or wireless systems. Another great example would be things like consumer staples. The stocks have not been great performers of late, but whatever happens in the world with AI, people are still going to need laundry detergent from Procter & Gamble, or they're still going to buy Coca-Cola, or they're still going to buy coffee and chocolate and pet food from Nestle.
You own Procter & Gamble, and you own Coca-Cola, and you own Nestle, correct?
Correct. We do own all three of those.
Give us a name or two of logistics companies that you own in the portfolio and also in the communications area.
Yeah. So we own Union Pacific, the railroad, and we own a company called Old Dominion Freight Line, which is a LTL, which stands for less than truckload carrier. They're the best, most profitable LTL carrier in the country.
We're speaking with Mike Clarfeld, who also owns communications companies that move data. One of the ClearBridge Dividend Strategy's largest and oldest holdings is Comcast.
So we own Comcast, which the stock has not done well for the last couple of years. And the challenges that Comcast faces is that for a long time, the broadband industry was really a two-horse race between the cable companies and then companies who would come into their territories and build fiber optics networks. And while the fiber optics entrants were relatively new competitors over the last 10 to 20 years, it was a stable duopoly that was highly profitable. In the last couple of years, what's happened is that you have the wireless companies providing a service called fixed wireless access, which is where a consumer can, for $25 or $30 a month, call the wireless company. The wireless company sends them a little antenna with a plug that you literally just kind of plug in. It's a very easy setup and install. It doesn't require the cable person to come out and spend 6 hours routing wires around your house. And so that has added a new entrant, which after a very long time of sort of stable duopolistic industry structure has proved disruptive. Ultimately, we think that that is a niche product. It's probably turning out to be a larger niche than we had thought it would be. But because of the constraints of spectrum, as people use more and more data, it's just not a practical or cost-efficient solution. And so while the cable industry is suffering its lumps right now as the market kind of adjusts to a new equilibrium, we expect that to happen over the next year or so, and that the industry will return to growth. We also own T-Mobile, the wireless company. T-Mobile is actually a good story for us. T-Mobile is a company we had admired for a long time in the United States, really for the last 10 years or so. The company has been the most dynamic player in the wireless market. They have a superior service given their spectrum position. They're able to provide best-in-class coverage at a meaningfully lower price than AT&T and Verizon, which is a pretty powerful combination, right? Better service and better price. We had admired it for a long time, but it didn't pay a dividend for most of its history. And then about 2 years ago, T-Mobile initiated a dividend, and we bought the stock the next day. And one of the things I think that differentiates our approach to investing in dividend payers compared to some others in the space is our approach to companies who initiate dividends. So every company we own, every stock we own pays a dividend, and we say that the company needs to be a dividend payer in the letter of the law and the spirit of the law. And what we mean by that is a letter of the law, simplistically, the company needs to pay a dividend. It's a yes or no question. Does it pay a dividend? But just paying a dividend isn't enough. If you pay a de minimis dividend and it's not really a meaningful part of your capital allocation philosophy, that doesn't work for us. But we are willing to buy companies that are newly dividend payers, recently initiated. Even if the dividend's small to start, if they have a commitment to grow it, then that can be a great candidate for us. And that's what happened with T-Mobile. We followed it for a long time, hoping they'd initiate a dividend. They did. We moved quickly when they did it, and it's been a great stock for us. And I'd compare and contrast that with others in the space. Many others in the space have rules about a dividend history. Like in order to be considered for inclusion in the portfolios, the company has to have paid a dividend and raised it for the past 10 years. And there's nothing wrong with that per se, but it does mean sort of by definition that you're going to miss those companies who are transitioning in their corporate life cycle from not being dividend payers to dividend payers. T-Mobile is a great example of that. And two other great examples of that for the last 2 years have been Meta, Facebook, and Alphabet, Google. both of which, again, terrific mega cap companies that for most of their corporate history did not pay dividends, but in the last 2 years have initiated dividends. And because of our dynamic approach to dividend investing, we've been able to get involved and profit from that.
We're continuing our conversation with Mike Clarfeld about what else it takes to make it into ClearBridge's dividend strategy portfolio.
The Clearbridge Dividend Strategy, I like to say, is a bit like the mom and apple pie of investing. We buy high quality companies that we endeavor to hold for the long term and do it in sort of a low risk conservative manner. And the portfolio is about a 50 stock portfolio. And we're looking to buy great companies that we can compound in for forever. Inevitably, you can't hold every stock for forever. Sometimes you got something wrong, right? You thought it was a terrific business that wasn't never going to change, but something did change and the business isn't as good as it used to be. Sometimes a company gets acquired, and so you have to say goodbye to your child as it leaves the nest. And sometimes the valuation, you may do so well in the stock that the valuation gets to a point you're not comfortable holding it and think you can find better opportunities elsewhere. But when we do find a new stock or do buy a new stock, we really are buying it with that view of hoping we can hold it for forever. And as you mentioned, we own several stocks in the portfolio that we've owned since we launched the strategy in 2003. And interestingly, the launch in 2003 is actually not arbitrary. In 2003, the tax code changed so that dividends became taxed at the same tax rate as capital gains, which meant that dividends were preferentially taxed. And we thought that in the early 2000s, coming out of the tech bust, that the change in the tax code would lead to a sort of renaissance in dividend investing. That's largely taken place. It probably took longer than we thought it would, but you now see that most of the largest companies in the country, including many in technology, now pay dividends. So the approach or the objective for us is to put together a high quality, diversified portfolio of about 50 companies that pays an attractive upfront yield, that owns companies that can grow their dividends very powerfully over time. So historically, our average portfolio holding has grown its dividend at about a 9% rate each year, which we think is terrific. As my old partner, Hirsch Cohen, used to say, where else in life can you get a 9% raise every year? So the first point we talk about is an attractive upfront yield. It's typically 50 to 100 basis points higher than the S&P 500. The second point is that powerful dividend growth. And the third point is strong downside protection. And so what we're looking for when we invest in new companies and our underwriting process is about finding great businesses with big moats. And when we talk about moats, we mean an attribute of the business, of the industry, that enables them to earn superior returns. In other words, superior margins, superior returns on invested capital, and that we believe, because of our analysis, are going to be able to be durable. And so what that means is that we spend a lot of time sort of focusing on particular companies and industries that we think we can understand, and often following those for a long time, waiting for an opportunity. If you look at our portfolio, you'll find that there are a fair number of companies that represent plays on similar themes. One of the themes that we find that we're able to underwrite with confidence and conviction is things about logistics. And so at one level, that could be something like owning a railroad or being the largest less than truckload freight company in the country, a company called ODFL that we own, which owns a very powerful freight network, or we own Union Pacific, the largest railroad. Those would be very hard to replicate. You could never build a new railroad from scratch today. It would cost literally trillions of dollars. Other logistics type companies that we focus on are companies where you have a product that's not worth very much and where the transportation cost is a high piece of it. So interesting things that businesses you might not think have a lot in common, businesses like the garbage business or the gravel business or the industrial gas business, right? All three very different products: garbage, rocks, and oxygen for hospitals. The key thread that runs between all of them is that the logistics costs are a meaningful percentage of the total cost to the customer. And what that means is that these companies have strong sort of local monopolies. Garbage, you think about it, you don't want to spend any more transporting it than you have to. And what that means is that if one person has a dump that's much closer to you than the competitors, they can charge you a lot to use that facility, because they know that your only alternative is to send it hundreds of miles away, and that won't be economical for you. The same thing happens with aggregates if you're doing a construction project. The quarry that's closest to you really has a natural monopoly, and because of that, they can really extract pretty high prices. And so we end up finding insights like this and being able to propagate them throughout the portfolio And the beauty of that is that we have a strong understanding of sort of what provides the moat in that kind of scenario, and that there's a similar dynamic with each of these companies, but the underlying economic drivers are very different.
So I've got to stop you there, Mike. I'm really intrigued by gravel and garbage. How are you investing? What are the companies that are able to take advantage of the markets that you're describing?
Yeah. So in the garbage business, it's Waste Management, right? The largest garbage company in the country. And they have a network of garbage dumps around the country. And unsurprisingly, it's very hard to get permitting for new garbage dumps because number one, there's environmental considerations that are meaningful. And number two, nobody wants one of those in your backyard. If you own one that's already permitted and operating, it has a lot of value. On the aggregate side, the fancy word for gravel is aggregates. And we own Vulcan Materials, which is the largest aggregates player in the country. Vulcan has raised its prices every single year in its corporate history, which you don't see very often. And probably the most robust proof point around their profitability and their business model was the financial crisis. So, right, the financial crisis was started mostly with a residential real estate crisis and the subprime-ish crisis. And so in 2008, 2009, 2010, their volumes declined by it's so staggering, it's hard to believe. Their volumes declined by 60%,
Wow.
60. Yeah. And yet they still were able to raise price in each of those years. And I can think of almost no other business where you would see your business decline by nearly 2/3, but you're still raising your prices year in and year out. And so what's neat, going back to sort of this idea of having an insight that you understand and being able to propagate it throughout the portfolio, is that we're able to invest based on this understanding, but with different end markets and different economic exposures. So going back to garbage is broadly not a particularly cyclical industry, whereas construction is a highly cyclical industry. While we own companies based on the same sort of underlying thesis of what makes them great businesses, they're exposed to very different end markets. Other insights that we've had that we've been able to do are things like, again, infrastructure networks. So we own things like pipelines or railroads or
So Williams, the pipelines.
exactly.
Right.
Williams, the natural gas pipeline. I've mentioned this under logistics, but we own Union Pacific, a railroad. We own Comcast, the cable company. We own American Tower, who owns the cellular towers. We own Public Storage, the largest self-storage company in the country. All of these are companies with physical assets that would be very hard to replace and really have strong value to the owners of them.
Mike, since you took over the ClearBridge Dividend Strategy Fund in 2009, it has delivered average annualized total returns of 12%, which of course is the combination of capital appreciation plus dividends. Now that's pretty impressive, but it still trails the S&P 500, which is the industry benchmark. But you've made the point to me that you don't hug the benchmark like so many of your peers do. Why not? And how do you get away with that competitively?
Going back to sort of the three objectives I talked about up front, attractive upfront yield, typically 50 to 100 basis points better than S&P 500, strong dividend growth. Our average company's compounded dividends at 9% a year, and create a portfolio that's conservative and protects capital in down markets. And again, going back to our long-term performance, compounding at 12% a year since 2009 was something we feel very good about. At the same time, it's obviously important that we have benchmarks and that we can use them to evaluate people's performance.
We were discussing market benchmarks like the S&P 500 and how problematic they have become for money managers who are trying to match or beat them. With ClearBridge Dividend Strategies, Mike Clarfeld.
We believe that the industry and the market has reached a unique point vis-a-vis benchmarks. If we think back to benchmarks, I think were really introduced in probably 1960s, 1970s as being important parts of the investment process. And obviously, the idea of a benchmark is that it's supposed to be an impartial yardstick of performance. Where we are today in the market, however, is a point where we think that benchmarks in some ways have become the use of them has become a bit inverted. The benchmark should be, I'm going back to the yardstick example, it's the ruler you pull out at the end to measure performance. Given the evolution of the industry and given the concentration in the market today, we are often finding that the benchmark for a lot of investors is not the ruler they pull out at the end, but the planner they pull out at the beginning. And what we mean by that is that, again, today, the most prominent feature of the market today is its incredible concentration. Right? People think that the S&P 500 or these major indices should be broadly diversified indexes, but today the S&P 500 is not broadly diversified. As we think about relative performance of investment managers versus the S&P 500 or versus a benchmark, there's the backwards looking aspect to it. There's the forward looking aspect to it. And then there's the trade-off between return and risk. We believe that there's a lot of risk involved in the market right now, or for players in the market right now who are mechanistically investing alongside the S&P 500. We think about diversification, and simplistically, it's the don't put all your eggs in one basket. And we were talking about this recently at work, that literally that's the first lesson that most people learn about investing when they're a kid. And it may not be about even investing in the stock market. It's about protecting whatever it is that they value. Don't put it all in one basket. And today the market is effectively putting it all in one basket. And what we've seen so far in 2026 is actually a bit of a change from what we had seen the few years before. And so I think in the lead up in the last few years, ever since the Chat GPT moment in late 2022, there had been tremendous investor enthusiasm about technology, and it had been pretty one-sided, right? AI was going to be this huge growth driver with a lot of positive attributes to it. And investors were willing, and not just willing, but enthusiastically getting behind technology for all of the growth that would come from that, but really weren't focused too much on the risks of what would happen as AI became a big factor in society. And what we've seen in early 26 is actually now investors are starting to get concerned about the risks, and particularly where we're seeing that is in software. It represents a potentially existential risk for software, that AI, as it gets better and better, can effectively write its own software, and that is a real threat to the existing software players. And this is really quite a powerful change in the market, because up until this moment, software has generally been one of the most highly valued areas of the market. Software has historically had a number of attributes that made it really coveted by investors. It's predominantly recurring revenue. The companies have had a lot of pricing power. It requires effectively no capital to build. So it's very high return on invested capital. And it's become a large part of the economy. So what we've seen is that in 2026, software, which represented about 15% of the S&P 500, has really experienced a lot of volatility. And that's just one example, but it goes to the risks of being overly concentrated in one area. And we feel like, as we think about benchmarks, as we think about performance, and as we think about risk, it feels like we may be transitioning from a moment in the world where, while that's been a risk that we could observe, it's one that hadn't come home to roost. And it now seems like actually in 2026, potentially investors are going to understand the consequences of being overly exposed to that degree to one sector.
What's your view of AI's impact on software? Do you own any software companies in the dividend strategy?
We own a little bit of software in the ClearBridge Dividend Strategy portfolio. We have a position in Microsoft, which is obviously a major software company, but also a major player in AI. And that's really the only direct software company we have. So whereas I think software represents the low teens percentage of the S&P 500, it's probably 3 or 4% of our portfolio. Interestingly, the reason we're so underweight software is not because we're so smart and realized that AI would get rid of software one day, or might potentially get rid of software one day. Rather, I think our underweight in software reflects a couple factors. First off, it reflected the valuations in software over the last couple of years. The software companies were so highly valued that there was not much margin of safety in case something went wrong. And of course, the thing with investing is things do go wrong. And being a smart investor doesn't always mean that you're smart enough to predict what it is that's going to happen. But it does mean being smart enough to know that when something's really expensive and doesn't leave much room for uncertainty, it represents risks that could go wrong. And so I think our underweight to software this year, our meaningfully smaller exposure there, doesn't reflect the fact that we knew that AI would be a real risk to software in 2026. We certainly considered that it would be, but it really just more reflected the fact that the valuations left no margin of safety in case something did go wrong.
I was really intrigued by the fact that on average, the companies in your portfolio have grown their dividends by 9% a year over time. Is that intentional? Is that what you're looking for? Are you looking for companies that are going to grow their dividends on an average of 9% a year, or is that just the way it worked out?
We've always emphasized dividend growth.
Mike Clarfeld, who has managed the ClearBridge Dividend Strategy Fund since 2009, is talking about the important role that dividends play in a portfolio.
And so as we think about dividends, right, provide a few benefits for investors. First off, obviously, they provide upfront cash flow, right? You get some checks a couple times a year, and you can use those to pay your bills. The second thing, and really probably the most important thing about dividends for us over a long period of time, is that they grow. And so, unlike bonds, obviously, right, which are fixed income investments, high quality dividend payers and companies over time tend to grow their dividends. And this is critical both in terms of growing income and cash flows, and also as we think about, particularly you think about saving for retirement, important in terms of staying ahead of inflation. And inflation has obviously not been a big factor in the investment landscape or in the economy for many decades or up until the last few years. And so I think for a long time, people lost focus on the importance of positioning for inflation because it wasn't a major factor in the economy. And unfortunately, since COVID and now with the war in Iran, inflation seems higher and more persistent than it had been in the past. And the beauty of dividends is that even during 2022 and 2023, when inflation was really quite rampant, dividend growth stayed well ahead of inflation. And that meant that you were expanding your purchasing power. And so as we think about what we expect going forward, our average company has grown its dividend at about 9% rate a year since we launched the product over 20 years ago. And we broadly think that can continue. And that's obviously a very powerful driver for returns over the long term. And then the last piece of dividends, which is critical, is the way they protect volatility or insulate against volatility in down markets. Time and time again through investment cycles, we see that during bouts of volatility, when the market sells off, dividend payers tend to outperform because when a stock's going down, it's hard to say where it's going to bottom. But if you're able to buy a high quality company based on its dividend yield and say, I don't know exactly where the stock market's going to go in the next 6 months, but I'm able to buy this company and it's paying me a 4% coupon that's growing over time, it gives people a good signpost for thinking about how to navigate.
Mike, at the end of every Wealth Track interview, we ask each of our guests for a one investment recommendation. We've obviously been talking about a portfolio approach of companies, high quality companies that are paying dividends and growing their dividends, more importantly. So, what would your one investment for a long term diversified portfolio be?
The acronym I mentioned earlier is an apt one for today's market. That idea of a halo asset, things that have hard assets, operate in the physical world, and low risk of obsolescence. And we've always liked those, but really, given the tremendous change that AI is likely to bring to the economy and society, we think that's a pretty critical starting point for thinking about it. Within that, we have several businesses. We like the industrial gas business, where we own companies like Air Products and Linde. I've mentioned waste management, to the cellular tower companies like American Tower. So there are several of those. Of course, the caveat to that being that just because it's a great business doesn't always mean it's going to be a good stock, right? And the key driver for that is valuation. While these are businesses that we think are great for today, tomorrow, and 10 years from now, being great stocks also requires that the stock prices are great at a going in value. That's why we think it's critical for investors to always be patient. One of the things that we talk about a lot with our analysts, we have a terrific group of analysts we work closely with every day, and they're pitching us on their ideas and they're excited about them. There are so many companies out there that we would love to own. Inevitably, though, many of them we will never get to. They will never get to prices where they're cheap enough that we can underwrite the investment in them with enough upside, but also enough downside protection.
Taking the Halo acronym, the hard asset, low risk of obsolescence,
Yeah.
and looking at an attractive valuation, which of the companies that you just mentioned would you highlight? Air Products, Linde, Waste Management, American Tower.
Okay, I'm going to throw one other one in there that we've been buying of late, which would be Otis Elevators. We recently initiated a position in Otis Elevators. When you think about the elevator business, it's a classic hard asset, low obsolescence. Whatever happens with AI and technology, people are going to still need elevators. The drivers for the elevator business is not so much new construction. That's a meaningful part of it. But the biggest part of it is the aftermarket, right? So whenever you get in an elevator, you probably see that little certificate up there that says it's been inspected not so long ago by the state or the county or whatever. So there's a tremendous amount of regulated maintenance. It's a pretty oligopolistic industry. So there's a few large players who operate pretty rationally. And the stock have recently come under pressure. And so today you're able to buy Otis Elevators at a price that we think embeds relatively modest downside. And we think that over time, you'll be able to compound returns. It's not going to be the next NVIDIA. It's never going to be a great growth company. But in a world where there's so much uncertainty about what the future brings, this is an industry that we have a high degree of conviction is going to look similar 5 years from now, 10 years from now to what it does today, and that it will continue to be a highly profitable one. And so you're able to buy a company at a greater than 5% earnings or free cash flow yield that we think will be able to grow nicely, not hugely, but nicely over time, compounding returns and protecting one's capital.
So interesting. And I don't think there's a listener in our audience who has not been on an Otis elevator at some point in their lives, so, and are grateful that they're being inspected as well. Mike Clarfeld, thank you so much for joining us on Wealth Track. We really appreciate it.
Thanks. It's been a pleasure being here.
For more information about Michael Clarfeld and the Clearbridge Dividend Strategy and other top-rated portfolio managers, go to wealthtrack.com. Don't forget to follow us on Facebook, X, and our YouTube channel. Thanks for listening, and as always, make the week ahead a healthy, profitable, and productive one.